Welcome back. We're busy with Class of Business 7 investments. The next session we will look at is Unit 2.4. And in this session, we're going to discuss property markets. Right, let's first look at what is a property market. A property market is an economic commodity. Property is valuable because it can be used and it is a relatively scarce commodity. As an investment, property has several features that distinguishes it from other investments. Namely, property differ from one another. That is, they are not homogeneous. It is not always easy to convert a property built for one use to another because the design of the building may be specialized, and property tend to be an illiquid investment. Now, which factors are affecting your property values? Property is particularly sensitive to changes in political, social, and economic conditions. Consider, for example, the different performances of residential property prices in Cape Town and most other parts of South Africa in recent years. Consider also the impact on prices of the movement away from standalone homes to the cluster development that provide security services. So the way that the property and where the property is situated is also important. So place also makes a difference in the price of property, or they call it location. Right. If we look at property as an investment, there is various kinds of properties that we can look at. The one is a full title deed property. That's where you are the owner of the property. You've got the title deed and it belongs to you completely. Then you get sectional title properties, property syndication, where a group of you come together and you invest in a property. Then you get retirement villages, and some of these retirement villages, they're on a scheme where you never become really the owner, but you can stay there, and when you pass away, then that property goes back to the retirement estate. And then they pay you back, let's say, the value plus some interest or growth on that. Then you get share block property, participating mortgage bonds that you can take out, retail estate investment trust, or short they call it REIT or REITs, and then you get your PLS or your property loan stock. Right, so investors receive income in the form of rent or on interest and capital when property is sold. And investors pool their money with other investors to purchase a share, let's say a part of a unit that is like in property syndication, or a full deed in a property, or in a specific investment vehicle, which is not necessarily a physical property, but the conglomerate. Let's say you purchase a share in a shopping center. You don't owe the shopping center, but you owe a part in that shopping center through your share. Right, further factors affecting property values is the value of the residential property is greatly influenced by interest rates, because buyers often need to raise a mortgage to buy a house. The amount that they can borrow depends on the rate of interest being charged for the mortgage bond finance. In recent years, the values of commercial and business properties in central business district declined as tenants tried to escape from the crime and grime of the central business district by moving out to suburbs. The decline in the value of these properties, however, attracted developers who saw an opportunity to make a profit by refurbishing these properties and then reselling them. In contrast, listed properties has been the best performing asset class for several years. The decision to invest in property is also affected by the costs involved. There's transfer duties, there's conveyance costs, there's bond registration costs, there's estate agents commission. These are just a few of the expenses that you incur, when you purchase a physical property. A full title to the property, like residential properties, is purchased as an investment to earn a monthly income from a rental revenue and to make a profit when the property is resold. It is challenging to ensure that the property purchase will prove to be a good investment, because certain factors should be considered, namely the price of the property purchase is relative to the similar properties on sale in that specific area. So if the whole area's property prices drop, then obviously yours will also come in line with them. A reputable area is likely to ensure that the property value will rise with market levels. Value will be affected by any impending development taking place near the property. The conditions of the property will hint at future maintenance costs. The features of a property can add to its value and also attract tenants, depending on how well you finish the property on the inside and what you offer extra with the property. The crime rate in the area also plays a very important consideration. I've seen it with our property. We've closed our area off, and now our properties are sought after properties. We don't see signs for this property is for sale in the area I'm staying. You just see new people moving in. So the properties are just so sought after because we've got virtually no crime in our area for many, many years since we closed the area. Right, then you get your sectional title property. A person may become a registered owner of part of a building as well as part owner of the land and common property under what they call Sectional Titles Act 95 of 1986. The complex is controlled by the body corporate. The owner of any section of the building is a member of the body corporate. Management and administration of the building fall to the body corporate, which acts as a separate legal person. A property management company may be appointed to take over the responsibilities of the body corporate at a fee. Then property syndications. A property syndication involves a group of investors who pool their funds in order to purchase a commercial or industrial property through a company. To invest in the property syndication, units are bought from the syndication management company. The units typically comprise of a share and a loan component. These units are usually, let's say, for 10,000 each, and the number of units are acquired by one investor is limited to, let's say, 25% of the overall shareholding in the property. The income from the property is received quarterly and is paid out as a percentage of the net rental received in proportion to the shareholding. Units may be sold at a capital loss or a gain depending on the market conditions. It would depend on the demand for syndication at the time of the sale, and when the property is sold, unit holders receive their initial loan amount and a capital profit on the shares that they hold. But let's have a look at an example of property syndication. Let's say a 1 million property is sold after 10 years for, let's say, 2 million. If R1 of the initial 10,000 investment is the share and the rest is the loan account or loan amount, the unit holder will then receive 9,999 on their loan account and then R1 for the share plus a capital profit of, let's say, 10,000. Right, property syndication are not very liquid investments. They also respond sluggishly to new opportunities, which may increase the profit margin of the investment. Large institutional investors are usually the first to take up desired projects. The investment can be very successful if the syndication company is well organized and roll profits from one project to another. The skills of a developer, attorney, accountant, contractor, and financier are also very useful in this regard. Right, let's have a look at retirement villages. The percentage of the population classed as aged is increasing. The South African crime situation has also led to the security of a retirement village becoming more attractive. However, legislation governing housing development schemes for retired people has led to a decrease in the number of units coming to the market. A developer may not receive money until the complex is certified as complete. If any money is received in advance, it must be placed in a trust account and may not be used by the developer. To secure the elderly participants' tenure, the developer must provide financial and completion guarantees. No developer may alienate a housing interest unless the title deed has been endorsed to the effect that such land is subject to a housing development scheme. The resident's right of occupation will be favored above the claims of all the creditors. The person's right of occupation is protected even if the retired person has not already received ownership. Only if 75% of the holders of the rights of occupation consent to the sale may a sale of land free from these rights be effected. Thereafter, holders' claims are ranked above the claim of any mortgagee for the amount already paid by the retirement person for the housing unit. Alienation without consent from the holder are not valid. An income tax exemption is conferred to a company or association involved with residential accommodation under sale or lease for aged persons over the age of 60 years if the aged person in question or their spouses or dependents exclusively occupy the accommodation. There is a provision for a meal a day and a nursing service. Funds are used solely for the investment to fulfill the obligations of the acquisition. Employees do not receive excessive remuneration working at the retirement village, and assets remaining after winding up must be transferred to a similarly orientated tax-exempt institution. Right, let's have a look at share block schemes. Similar to a timeshare, a share block scheme gives right of occupancy in a specific section of a building owned by a company in which the investor owns shares. It is governed by a Share Block Control Act 59 of 1980. If the property is converted to sectional title development, residential units may be purchased. As shares are being purchased and not assets, a prospective investor would be required to take out a personal loan as opposed to a mortgage bond. It may result in higher interest rates. But let's have a look at participating mortgage bonds. Participating mortgage bond schemes makes investors money available as loans to buyers and developers of commercial and industrial property. Relatively small amounts of capital are accumulated to create a mortgage bond, not less than 20,000. The bond is a loan secured by a property and is thus only indirectly an investment in the property. The management company, a banking group or financial institution collects the funds and matches them to a particular borrower. The participating bond is registered to a nominee company. The registrar of collective investment schemes must approve a set of rules written out by the scheme. The nominee company acts as custodian of the security and is prohibited by law from incurring any liabilities. Participants have the right as registered mortgagees. The participation bond may not form part of an insolvent estate of the nominee company or the management company should insolvency arise. The Collective Investment Schemes Control Act 45 of 2002 protects investors. It ensures that the part bond is a first mortgage bond. A maximum of 75% of the value of the property may be loaned. A minimum investment of 1,000 and a minimum investment period of 5 years are stipulated. The debt is owned to the participants and the scheme manager must submit full particulars relating to the amounts outstanding to each member of the scheme. Income is received from a monthly or a quarterly interest earning and is taxable. A participating bond can be used as security for a loan. However, the capital is tied up for at least 5 years and there is no capital growth on this investment. Right, let's look at REITs or real estate investment trusts. Before the introduction of real estate investment trusts or REITs, listed property tend to fall into two categories, namely property loan stock companies, PLS, and property unit trust, PUT or PUT. These entities were subject to different regulatory controls and tax treatment. A collective investment scheme in property operated as a trust both and for income tax purposes, while a property loan stock company operated as a company. A unified approach was then adopted and REITs were introduced in South Africa on the 1st of April of 2013. The REIT is the international standard and more than 25 countries use a similar REIT model. South Africa's REITs own several kinds of commercial properties like shopping centers, office buildings, factories, warehouses, hotels, hospitals, and to a lesser extent, residential property in South Africa. Some REITs also invest in property in other countries. The objective of a REIT is to provide investors with steady rental income and capital growth in the underlying properties. SARS, South African Revenue Services, laid down the following criteria an entity must meet to qualify as a REIT. The requirements are as follows. The REIT entity must have a minimum amount of gross property assets, direct interest in immovable properties such as land and buildings, interest in a lease relating to the immovable property, the interest in a property subsidiary or holding in another REIT above 300 million. The REIT entity must solely invest in immovable property assets and collateral debt instruments and hedges used to reduce the risk associated with property-related loans. At least 75% of its income must be from property rental. The REIT entity must distribute at least 75% of its profits yearly, and the REIT entity must not have excessive borrowings, for example, gearing, concerning the total gross asset value of an immovable property held by the entity. Debt may not exceed 60% of the assets. The above requirements must be contained within the trust deed in the case of a put and in the memorandum of incorporation in the case of a PLS. In the case of a put, the trustee will be responsible for submitting the certificate of compliance to the JSE. In the case of a PLS, the director will be responsible. A REIT will be exempt from capital gains tax. The holder of the share or the participating interest in a REIT will be subject to tax. Receipt of accruals received by a REIT from a financial instrument will be treated as ordinary income. Right, let's have a look at property loan stock, and here we'll compare property unit trust with property loan stock. The property loan stock are listed on the JSE. They offer the investor the opportunity to gain exposure to property market without the restrictions of a put. The following table itemizes the differences between a put and a PLS. Right, so we look at the property unit trust. Must have a financial institution as a trustee. Collective Investment Schemes Control Act governs the affairs of a put. It must pay out all income over a particular year to the investor, and it could historically not gear more than 5% and can now gear up to 30%, which does increase the risk element. If we look at the property loan stock, on the other hand, the trustee does not have to be a financial institution. It may be an attorney or an accountant. There is no equivalence legislation governing a PLS. It may elect to hold back income, and many options and choices are available to investors. Investors can buy either shares or debentures. Right, let's look at the advantages of property. It is a secure, stable, long-term investment with a thing on long-term. Prospects of capital appreciation are high. Property investments provide long-term, stable investments for the client. The risk is low and not very volatile. There is a lucrative second-hand market for properties. Paying off a bond is an effective after-tax return on the prevailing bond rate. Maintenance costs may be offset against rental income, thus providing effective tax structuring. So if you paint your house or fix a house or fix the roof or something like that, which is maintenance, you can then downplay that against your rental income and deduct it as an expense. What is the disadvantages of property? Performance is reliant on interest rate. Property investments are subject to capital gains tax on the sale of the property. Property investments have high costs, for example, transfer and legal fees. There are maintenance costs to maintain the property. Property investments are not very liquid. It depends on demand in the market, and the location can cause risk to the property. If you're in the wrong location, it might bring your prices down. But let's have a look at another form of investing, which is hard assets. Hard assets can be described as those assets that do not provide income and are tangible to the investor. An example of hard assets is collectibles, such as rare coins, gemstones, or Krugerrands. These investment vehicles offer the investment opportunity to make a capital gain over a period. The advantages of hard assets is they are low upfront or no management fees. Hard assets may have an aesthetic value. Hard assets may be used in a personal capacity. That you enjoy collecting, coins, enjoy collecting stamps, so you can use it as a personal asset. What are the disadvantages of hard assets? Hard assets are a long-term investment. There is not much capital growth over the short term. Hard assets may be damaged by nature, for example, a fire. Let's say your whole coin collection or stamp collection is inside your property. The property burns down, it might damage your collection. There may be capital gain tax implications. Liquidity depends on demand and supply. If there's nobody that wants to buy your old coins, then obviously you're not going to have a market. Costs may be high due to the insurance costs. Values are volatile and offer no guarantees, and investors may need to have specialized expertise in collecting these type of instruments. Right, so in the next session, which will be Unit 2.5, we will discuss financial instruments. Thank you for attending this one. Then we will continue in the next session when we discuss financial instruments. Thank you. See you in the next session.